Hello viewers, this is Saurav. In continuation to explain the taxation and complex world of taxation, today I wanted to cover a video on Australia and New Zealand double tax agreement. So Australian citizens, Australian businesses are very close partner of New Zealand, and same likely a lot of New Zealand citizens go and live there, and a lot of Australian businesses come and do businesses here. This double tax agreement becomes pretty critical, and this defines a lot of issues that businesses and people in general can face, and it provides a lot of guidance on that as well. So the technical thing, because if you try to read yourself, it's very technical and a lot of things may not be very straightforward to you. So today in my video of next 5 to 7 minutes, I like to decode some of those complexities of the double tax agreement. And if you do have any questions following up, my numbers or emails are underneath and you can contact us. Happy to help, because we have been helping a lot of people in the last 20 years of my career, especially dealing with international tax. And we have a lot of offshore businesses who I have advised in the past, who are based in Australia. And likewise, a lot of New Zealand citizens have gone over there. We help them, vice versa. And I do have some contacts in Australia as well, so I can always refer you if you have more technical questions there. So basically, this is the double tax agreement. So why do we have this double tax agreement? So mainly, this is a tax treaty between Australia and New Zealand, and it helps decide which country will tax what kind of income. It reduces the chances of paying tax twice in the same income. It applies to residents to one country or both. So you could be a resident of just one country, or you could be resident of both the countries. It's mainly relevant for income tax. Remember one thing, we're not talking about GST and PAY, those sort of the income tax. What we're talking about, that's the main thing. There are some little things here and there, FBT and stuff, but let's just primarily it focuses on income tax. That is the main thing, and this is the three main outcome we have. Decide which country can tax. It covers cross-border income when one income is happening in both the countries, and it protects you from paying double taxation. So it does not want to create a situation where you also pay tax in this country and you also pay tax in that country. It wants to avoid the situation, and it's got a framework set up so that that income is not taxed twice in both the countries. That's why it becomes very important. We do have double tax agreement with a lot of countries, but this one is always have a lot of questions and a lot of explanations, and a lot of basically it's in demand because there are more users for this specific DTA. Now, residency, this is what I wanted to cover today, and permanent establishment for businesses. So these two things are my main focus, because this affect a lot of people, like normal people like you and me. This affect a lot of people. So how does it decide who is a tax residence if both countries say you are my resident? Very fair question. You go from here, New Zealand to Australia, or Australia to New Zealand, you come from either or. Now, who decide that you are a resident of which country? If both countries says, no, you are my resident, you got to pay tax to me. So there is a tiebreaker rule is there. You can go and read yourself, but this is just my understanding of what it is. So first is permanent home. Which country has your permanent home? Permanent home means this is where you live, your wife live, your kids live. This is where you keep coming back on and off basis, and this is your predominantly, this is your home. Example, you live somewhere down in South Holland, in Invercargill, and you go to Perth for a mining contract. You fly in, fly out, 6 weeks there, 6 weeks here, 6 weeks there, 6 weeks here, right? But remember, this is your home. New Zealand is your home. You keep coming back here. So the first thing is permanent home. Your wife here, your kids going to school here, you're always coming back here. So of course you're a tax resident of New Zealand, right? So you can't shift the residency anywhere. This is permanent home is there. If permanent home is in both countries, yeah, I have my home there, I have my home there. both countries at the home. Okay, step number two. Step number two is closer personal and economic ties. So, in which country you have more financially, socially, economically attached to which country, where your vital center of interest is, that will be your tax residency. Okay, I have in both. I have exactly the same. Okay, that's fine. Move to next step. Habitual abode test, which is where you normally live, where you spend most of your time, right? Which is your uh, center of gravity. This is what they call in Australia, and we call it permanent place of abode. If that is in both the countries, okay, move to next level, which is nationality. What country you're a citizen of? What's the passport? What's the national? What is the citizenship that you have? Uh, and if you do not have a citizenship of any of that country, then it's a mutual agreement. If still unclear, tax authorities of both countries will mutually agree that which will be the case. So this is the criteria will be followed in this order in 5-step process. Of course, if step number one is has established the outcome, we won't even go to step number 5. So we only go to step number 4 and 5 if 1, 2, 3 do provide some sort of ambiguity and we can't reach to the conclusion. Then only we'll move to. Otherwise, step 1 will solve the problem. So if you're a New Zealand transitional resident, you will get some relief from some exempt income. So this is for 48 months from the date of your arrival. This is mainly for the new migrants into the country. And this is for individuals. For the companies, we usually look at where the effective management is. So for companies, I'm just going to cover in my next slide, which is permanent establishment. So if a business may become taxable in the other country, okay, so usually not a permanent place of establishment, which means your business will not pay tax here if you're just using a storage, display, or delivery only services. You're purchasing goods or collecting for information purposes only. It's a preparatory or auxiliary activities only for supporting some sort of your main activity. This is just being the supporting stuff, and you're using independent brokers or agent to act for your work. This means you do not have a PE. You will have usually a PE if you have an office, branch, factory, workshop, or place of management in this country. You're building or doing any construction which lasts more than 6 months. If services are performed in the country by a contractor over 183 days, and a natural resource activity for over 90 days, substantial equipment are being used for over 183 days to generate an income, of course, then PE will be there, and this is how your business will pay tax here. And this is some other examples of, so we have just covered the businesses and people. Now, this is just the example. I put together all of them together: business profit, dividend, interest, royalties, pension, directive fees, and employment income. So this is how it's taxed. Business profits are usually taxed where the PE is permanent place of establishment, which I just covered in the previous one. And dividends will be taxed in both countries with limits and tax credits. So tax credits cannot be transferred from there to here or here to there. Their franking credits can't be transferred here. Our imputation credits cannot be transferred there. So this is with source country tax where the income is generated, that is tax, but 10% is the gross interest. This is non-resident withholding tax. It can't be more than that. And for royalties, it's 5% of gross royalty. So if royalty is being paid from here to there, 5% has to be deducted before it's paid. Pension, generally where the recipient is a resident, this is where pensions are taxed. Directive fees will be taxed where the company is resident, and employment income usually taxed where the work is physically performed. And how this can be avoided? Of course, we don't want, the purpose is not to double tax anyone. The purpose is foreign tax credits will provide some sort of relief as well. So income, if it's earned in Australia or New Zealand, We'll go to step 2. The source country will tax the income, of course. The residence country will also include that income into their tax return. Step number 4, foreign tax credits will apply to that income. So this is the flow of information will happen. Let's give some examples. A New Zealand consultant go to Australia. He works there for 2 months with no fixed office, usually no PE. So these business profits will not be taxable there. If Australian builder coming to New Zealand, work on a New Zealand project over 8 months, likely APE because it's gone over 6 months of the project. So profits linked to that project likely be taxable. Person with ties with both countries, if both countries treat the person as resident, use the tiebreaker test which I just mentioned, which is a home, closer tie, habitual abode, and nationality. This is the order of that. So key takeaways for you to remember. Always any question, reach out to us. Happy to help and offer our guidance and assistance if you do have any questions. The DTA help decides which country can tax what income. Interest, royalty, withholding tax rates are kept onto that percentage. It can't go more than that. Basically, the idea is it to reduces the risk of double taxation. Foreign tax credits can be transferred. Complex situation will need people like us to answer, and residency and permanent establishments are two big concepts of this DTA. Residency and PE are the two big concepts. So today I tried to explain in a very simple terms that complex DTA agreement that we have. Happy to help if you have any question. Thank you for watching. Thank you.